and welcome to this special show on thematic investing by DSP Mutual Fund. A storyline that's easy to understand, clubbed with the possibility of robust performance and an abundance of new launches. Thematic investing is taking a lot of attention and has been gaining ground amongst investors. But at the same time, these investments are also prone to hype and speculation and may lead to high volatility in one's portfolio. And it's not easy to identify themes that will pay off, as well as underlying companies to invest in to take advantage of these themes. To throw more light on the nuances in thematic investing and to explain how it can be made a part of your asset allocation, I have with me today Mr. Santosh Joseph, partner and founder, Germinate Investor Services, a boutique investment and financial services firm based out of Bangalore. Santosh comes with 19 years of experience in the financial services industry across banking, asset management, and insurance. Santosh, thanks so much for joining us today. Welcome to the show.
Thank you, Shimona.
So before we start the conversation, request all viewers to share the questions in the chat box, and we shall take it up towards the end. So Santosh, let's begin by knowing more about you and Germinate. You have worked with professional groups, including DSP, for a very long time as well. What made you start your own venture? If you can talk about yourself, your journey, and Germinates as well.
Yeah, so this is a question that I don't get asked often. So maybe this is an opportunity for me to share our story. So as we speak now, like you mentioned, we are based out of Bangalore. We're a boutique firm, and as partners, we're about 6 of us, and we have some support staff helping us out. We started in 2016. Now, before this, as you know, I was working professionally across various organizations. And while I was working across all these organizations, my day-to-day interactions would be with, advisors and mutual fund distributors and banks. I saw that the business itself was expanding like massively. Like the gap between the people that were serving the need and the need was very, very wide. The number of new investors coming on board, and I also saw the green shoots of tech-enabled practices in terms of distribution and advisory coming up. We saw that investors were looking for someone who was unique, boutique, and would be relatable to them. Now, we felt the gap between a big bank to a national distributor to someone who could relate to the client at their specific domestic level. Therefore, the idea of Germinate came into being. That is, if we can fill the gap of being the friendly, relatable, trustworthy face that a client is looking forward to. So most of my customers, and rather Germinate's investors, are first-time investors, and we take great, credit for it because that's hard work for us. We do not go and poach existing customers. We like to talk to people who were aware of these things from a distant. We want to approach them, speak to them, make them feel comfortable, and offer a convenient way to help them get started on their investment journey. Now, all of them are investors, but the financial investments is where we come in, make them feel comfortable. For many people, they're scared of the word KYC. They don't know what is the CKYC means. They want to know, how do I choose a fund? How do I fill up a form? How do I track it? So we've actually gone from the grassroots levels and built a network and franchisee of what we've built so far.
Great, Santosh. That's a fascinating story. So how big is the company now, and how many investors are you guys managing? And also, if you could tell us about the profile of investors. Of course, you did mention that most of them are new buys, but if you can elaborate a little bit about your experiences with with interactions with your customers.
Well, I'll be honest with you. When we started, we only had family friends to go after. So, we would say, hey, listen, we've started and we feel that we can do a difference. And we went after family and friends who were not investors and got them on board. When they came on board, they said, hey, Santosh, can you fix this same thing for my colleague? Can you help my, son start an SIP? Or can I call you to my office to make a presentation to my staff? One thing led to another. So initially, we were, all over the place because many invites came, and we were also keen. And in the beginning, most of us are running after whatever business opportunity you get, or people call us. So we went all over the place. Then we realized our niche. The niche is that people want a friendly, relatable face. They want someone who could be honest, someone who could be upfront, and someone who they can relate to. So most of our clients have a similar thought process that we have. We think long term. We don't do any tactical calls. We invest for a really long period and we keep things really simple. So these things resonated well with the clients. So as we speak, we got over 1,000 clients between the six of us. Each of us manage between 200 odd to 300 customers. And we also have a support staff which takes care of all these people on a day-to-day basis. And our clients are typically people who are new or were 3 to 4 years old. Many of our clients are actually people who did something on their own in a DIY format or online format. And after a period of time, they realize, hey, I can't do this on my own. I need help of somebody who's a professional, who knows what to do and needs to be handheld. So bulk of our investors are new, or the investors who come in the last 1 or 2 years in the online channel, and they needed someone to take them through to the next leg of their investment journey. So that's our investment profile.
Great. And how does your team help build good portfolios for your investors? If you could also elaborate a little bit about the process that you guys follows before suggesting funds to your clients.
See, we've always told most of all our clients actually is that what is important is the right understanding. So we begin with trying to meet the client at a personal level, understanding who they are, what their work is, what is the day-to-day job, right? See, many customers forget that when you start investing, the first few days and months are very exciting, full of enthusiasm. Later, there is a drop in those energy levels. We tell them that's important to realize that you can't let that drop. Therefore, we come in the place and help them understand this. Now comes the other very important yet hygiene factor, like understanding the risk of the client, understanding the goal of the client, understanding why they're investing, and also understanding if they don't invest, what is the risk it entails by not investing. Once you tell these basic facts to the client and establish these ground rules, it becomes very clear. Second, we are not so keen on selecting the right mutual fund or the best mutual fund. Though those are very important, I think what is even more important is, number one, get the needs of the clients. Convert those needs into actionable goals. Now, when you have the needs made into goals, it becomes very clear what portfolio to build. In fact, you don't even need someone like us. You know what fund will help you. You know where your risk is, where you're not supposed to take a risk. It becomes easy. Within that, we have some parameters that tells you the age of the fund, the pedigree of the fund, the brand of the fund house that comes from, the pedigree of the fund manager. At some level, we also use metrics like the performance, though we don't chase performance, but we also like to see between 3, 5, 10-year period. If there's a consistency over there, we'd like to choose that. And we like to make all these easy for the client. Otherwise, so much of quant, it bogs down the client. So we try to make it easy for them. So a typical customer with Germinate will have a very simple portfolio of few funds aligned to their goals, something that is more or less aligned to their risk reward in terms of what they want.
Oh, great. So while you talk about risk, Santosh, we have also seen a big number of investors coming into the mutual fund space now in the last few years. They are beginning with tax saving funds, and then they get attracted to the idea of high risk funds like thematic or sectoral strategies. Is that the same for Germinate as well?
See, a certain portion of investors do come in and try mutual fund for the first time because they want to save tax, right? The Section 80C is a big draw. And the few distributors who do advertise saying that invest in mutual funds and save tax and let your money also grow. So we've seen that nice ads for ELSs which says, number one, save tax. Number two, make your money grow. And number three, the lowest lock-in period of 3 years. Now, when people come in, you have to tell them that even ELSs is a mutual fund scheme. Some people are thinking that ELSs is different, mutual fund is different. So you tell them that ELSs is a category under which mutual funds also operate a diversified multi-cap fund. Now, when they come in and the next 2 to 3 years, if ever they get a good upside on it, they get carried away, they get enamored with the good returns, because otherwise what are they used to? They're used to paying an LIC premium, or they're used to PPF at maybe 8% or less than 8. Then suddenly you see 10, 12, 15% return. They get carried away and saying, Hare Baba, only 3-year lock-in, why can't I put more money over here? Then they do the same thing. They chose an ELSs because they want to save tax. Now they'll choose a fund because they want to make money. They throw the rationale and logic of need, goal, risk, reward out of the window and choose what is the best performing one. So what they do, like go to Google tab bar, best performing mutual fund. And God knows what answer they'll get depending on the Google algorithm that works.
I guess that's a common problem for many of the investors, even we talk to. So, coming back to the main agenda of today's discussion, Santosh, if you can also explain to our viewers what are thematic funds exactly? Where exactly do these funds invest in, and how are they different from diversified equity funds?
So, let me make this simple. You have a particular list of stocks. Let's take Nifty or Sensex. Now, Nifty is the top 50 companies. Sensex is top 30 companies. Now, when you look at these, they're all various names. All of them do unique businesses. Now, the minute you start classifying a company based on the nature of activity, you start following a theme. Let's take, for example, the biggest theme that plays out in our index today is the banking. Now, you can call that banking as a sector, but banking has got to do with money. Now, if you just zoom out a little bit, you'll have NBFCs, you have home finance companies. You also have today insurance companies, both life and health insurance. You also have companies which are into distribution today. Now, the entire framework is financial services, stockbroking companies, right? Now, the theme is finance and finance related. Then you get multiple sectors within that. Now, when you buy Nifty, you're buying banking, you're buying pharma, you're buying IT, you're buying oil and gas, you're buying metals. But when you don't want the whole package, right? If I want to make it a little more simpler, if you come to my town and you come to a nice restaurant and you get that plantain leaf meal, you get multiple courses of food on your leaf, right? Some is vegetable based, some is meat based, and some is rice based, and all of them are categorized. Now, someone like me will first go to this desert because I got a sweet tooth. Now that's a category or a sector. Now some of you are used to eating only sweet. Now that's a theme. Some of you are used to eating only rice based. That's a theme. So here in funds, theme is when you go after a particular idea or an industry and play the opportunity that's available over there. Now, even if I take, let's say the pharma industry or the medical services industry, you got a whole gamut of funds sectors over there. For example, the hospitals, the pharma manufacturing, the diagnostic lab chains. Then you have the guys who manufacture hardware. So you got a whole team specializing in a particular industry. Eliminating the broad based is what we call thematic investing.
Right. So before I move on to the next question, to all the viewers, if you are enjoying the content, do share your likes and comments. And also, if there are any questions in your mind, please do that, and we shall take it up towards the end. Moving on to the next question for you, Santosh. How do you perceive thematic funds? Are they very risky? Could you please tell us who should be investing in such funds, and what should the expectations of these investors should be along the way? And also, most importantly, who should not be investing in thematic funds?
Good question, Shimona. So let me again use a very local example. So, Bangalore is known not only across the country, but across the world for the IT strength that Bangalore's got. Now, a typical person in Bangalore working, let's say, in one of the tech companies, is got a salary from the IT company. A large source of his wealth, whether it's bonuses or ESOPs, is from an IT company. And even his investments, if it is an IT company, is extremely stuck in one industry. So someone will say, hey, listen, Santosh, I got too much exposure to the IT industry. I'd like to, let's say, focus on the pharma or the banking industry. Now, for such a person, he is diversifying from the industry that he's in. Now, if you're not such a person, then being in diversified funds is, hey, I'm going to go and put my money in a basket of multiple industries because I do not know personally. And even the economy signs are not very clear about which industry is going to be specifically doing well. It's like, instead of searching for the needle in the haystack, there may be 2-3 needles. You may find it. But why don't you get the whole haystack? Because you will eventually know there will be few needles in it. Likewise, The reason why it is risky for some and not risky for some is why are you doing it? I think begin with the why. Now, if I am someone who's in the IT space, and if I am saying I do not want to specifically be in the IT space, your question is answered. I don't want to be in IT because I'm already working for IT. My ESOP, my salary, my bonus is connected to the IT industry, which is anyway I'm beneficiary of. On the other hand, there are some people say, listen, I believe in IT. This is the only thing I understand so clearly well that there's absolutely great opportunity. And because of the knowledge and the information that you have, it qualifies you to take that outsized investment opportunity. But if I'm a regular salaried class or businessman, I do not understand IT industry. I have a vague idea that it may do well. If I go overboard, now I am putting myself at risk. Now, making money is not about taking excessive risk. It's about taking the right amount of risk and ensuring that the risk reward is in your favor. So, summing it up, when someone is choosing a thematic idea for investing, if you have a reasonably good understanding, it makes great investment sense to be in a particular theme. If you do not have an understanding and if you're playing a fad, then in my supposition, it becomes a risk because you're trying to bet, right? On the other hand, if you say, listen, I like the themes, I rather choose a diversified fund which has got these themes playing, then you're playing a beautiful, simple, diversified strategy saying that I will let my portfolio manager decide whether I should have IT in my portfolio, whether I should have banking in my portfolio, whether I should have pharma or metals or whatnot into my portfolio. So it is specifically cut out for an investor who clearly knows what he wants. It's like going to an a la carte restaurant and deciding not to go to a buffet restaurant to say, I know what I want. I'm going to get that in that restaurant. I'm going to go there and eat. You cannot go to an a la carte and wonder why I'm not getting a buffet spread. Likewise, if you go to a buffet restaurant, you can't say, I'm only going to eat one portion. Don't charge me for the rest. It won't work. So I think here the operative word is a sense of awareness of what I want. If you're not aware, it's risky. If you're aware, you know you'll work with it.
Great. I think that's a great analogy that you mentioned. In fact, as I do my financial wellness sessions with the employees of different corporates across healthcare or technology sectors, I have always been mentioning them that they should be investing in the themes of the same sector they are working. And some of the common questions that are asked, and I would love to have your views as well on that, is how can thematic funds in principle add more value to an existing investor's portfolio? And if at all, I'm thinking about taking an exposure in thematic funds, what proportion of my portfolio should ideally be exposed to thematic funds?
Okay, so we have established the ground rule that I have information and I understand the entire thematic concept, right? It's a concept. Because if you don't want to do thematic, themes are already represented in your diversified equity fund. For example, you take any fact sheet of any diversified fund, it will tell you the mid cap, large cap, small cap exposure. It will also tell you the sectoral or the theme wise exposure. Now, we are going one step deeper and saying, hey, I would like a thematic exposure. Now, whether it's IT, whether it's oil and gas, whether it's transportation and mobility, or whether it's metals, or whether it's international investing, these are all large themes. Now, you have concurred based on your risk reward or based on your appetite or maybe even based on the need of your investment that this is where I want to be, right? So once you take that decision, then you take a call to say, hey, listen, I have 20 years time. I feel that the Indian IT industry, which is what we are best known for across the world, may be my big ticket to win, right? I'm going to double down on the IT industry rather than just being in the diversified fund. So what I'll do, out of 100 rupees of my money, let's say if I'm going to put 80 rupees of that money in equity, I'm willing to take 20-30% of my equity allocation to IT, and I'm willing to wait through one or two market cycles because, even every theme and market also go through their own cycles. Now, the opportunity here is that one, you bet on a theme. Number two, the team plays out well and it creates such a return that even a 20-30% will give you an alpha at an overall portfolio level. Now, mind you, that exposure that you take will define both the loss that you will experience or the extra return that you would normally get in a diversified fund, justifiable because of the extra exposure to thematic investment. Now, is there a thumb rule for thematic investing? There is no thumb rule. Only thing is that if you're playing one or two dominant themes, you at least have to play 10 to 15% each to make it worthwhile. Now, let's assume I got 100 rupees of equity to invest. If I put less than 10% in a particular theme, now even if the theme did really well, how much is it going to add to my overall portfolio? Not much, right? Now, if I'm going to put 5% in a particular theme, I might as well get that same 5% in a diversified fund. Now, if I am very convinced and I have great conviction, if I take a 15-20%, mind you, that's a good number. That number, if outperformed, can add meaningful value. Now, if you say I have two themes that I believe is going to do well, and let's take just as an example, I believe the Indian IT industry and the banking and financial services as a sector or a theme, these two are going to be 30-40% of my portfolio. Now, that's a large chunk. It will move your portfolio significantly and maybe give you a meaningful alpha that you would normally generate otherwise from a diversified equity portfolio. So I think, though I can't give a generic answer, but if you want to have meaningful allocation, which is something that makes a difference, that makes your effort worthwhile for choosing the thematic fund, you should have between 10 and 15% in that specific theme that you're so interested in to make it count at the portfolio level.
Noted, Santosh. So 10 to 15% of exposure in any dominant theme is what you are recommending. Leading to that is my next question. In such a scenario, is a tactical entry and exit important, for such thematic investments? And if at all they want to do, how can investors figure this out by themselves?
Well, this is like asking, give me a number for which I can buy a lottery ticket and I'm going to win the $1 million sweepstakes. It's easy to have this conversation, but it's difficult to actually time a cycle in a particular theme. Now, I'll tell you what does happen though. Everybody tries to catch a theme at the top of its game. You know why? That's when there's maximum information, maximum performance, and maximum awareness. Sadly, most people who come into, let's say, an infrastructure theme or an IT theme or a banking theme is when the past 1 year performance is very, very good and it's better than the diversified equity funds. Now, my take on this is, if you really like a theme, you buy it before the theme plays out, not after. Or you buy it whether the theme is performing or not, because you believe that the idea will do better than the whole market as a whole. Now, if I were to take another step forward, we need to understand that these themes that we are talking about also go through a lot of cyclicality, right? Now, today, when you look at it, let's say infrastructure is just very quiet. Now, and let's say IT is doing very well. There's a good chance that people will say, you know what, IT is done well. And in your mind, you're playing this mental thought process. Bank India, exporting IT, rupee dollar at 82. I think IT can never go bad. Let's put money in IT. And then you take a 20-30% knock, you lost conviction, you lost patience, you sell at a loss, and you come back to some other sector. So rather than go up and down like it's like switching lanes in your toll plaza, don't do that. Stick to what you know, stick to what you understand. It's better and safer to be in something that you're comfortable, that you understand, and also you're willing to see the drawdowns play out because you're playing for the upside. It's the story of conviction. So summarizing that, I think thematic is not for everybody. The concept of strategic versus tactical is given on the fundamental aspect that I know when a cycle is going to play out. So I'm going to buy IT today. It's going to perform well in the next 2 years. At the peak of it, I'll remove. I wish life was that easy and simple for us to enter a sector when it's at the bottom and exit at the top. It doesn't happen. But if you invested in a particular theme, it's 2 years, 3 years, 5 years, and you saw the theme perform reasonably well compared to the index, maybe that's the time to profit book or even exit. So I would say rather than entry, it's a lot more easier to time the exit when you experience the desired outcome, which is outperforming the market and outperforming the diversified theme, right? Then you take out some money or maybe reduce your exposure or maybe trim down your exposure to the initial exposure. But I know there are people who say we'll take a tactical call. But the question is, the tactical call, if it doesn't play, will become a strategic call because you have to keep it for long term. So I'm sorry if I don't give you an answer that you were looking for, but this tactical and strategic is sometimes very loosely used. If it's tactical, then you need to know when to get in, when to get out, and you should also be prepared to say, "Hey, did I get in at? Did I get out at a loss, or did I get in at the desired outcome that I came in for?"
Right. So, in short, what I could say is I would probably take or I should take an exit call if I see outperformance as compared to a diversified category. That's what you wanted to highlight, right?
Absolutely. See, the outperformance is the proof of the pudding. For example, in the last 1 year, let's say Nifty is flat, but the sector that you invested in, it gave you 10 to 15% return. You should be happy. At this time, pause and ask yourself a question. Should I continue or should I be happy with the 10, 15% return to get back into some other sector or maybe a diversified fund?
Great. So before I move on to the next question, just a reminder to all my viewers here, if you are enjoying the content, do share your likes and comments and the questions as well. We should take it up shortly. So moving on to my next question, and quite an interesting one, Santosh. What are the thematic fund strategies that you have been recommending to your investors in the recent times?
Well, I'll be honest with you. I'm very wary of recommending any thematic ideas because, like you mentioned, the starting, I got 20 years. And in this 20 years, one of the lessons that I've learned is thematic schemes perform like beautiful roller coasters. They start low, they take you to a high, they bring you low, they take you to a high, they bring you low, and they leave you back to where you started. I would rather, if my clients or anybody were willing to listen to me, build a more robust diversified equity fund portfolio. But today, the situation is a lot more different because there are investors who are so discerning and they're willing to take that risk or informed decision that we can mix up 3-4 unique themes and make it that into it as a diversified portfolio. Then what we do, we try and do negatively correlated thematic schemes. For example, I take the infra space, I take the IT space, and then maybe I add the metals or the logistics space. What I'm trying to do, I'm trying to stay away from the generic diversified funds. I'm trying to not take a risk on one theme, but use 3-4 themes to build a portfolio. So that's what I do. Now that is also depending on the opportunity that I get. So today when we look at IT, thanks to the correction since Jan 2022, if today you would put a gun to my head, I'd say one could start looking at the IT space because it's come off the 2021 highs. The entire hype of the IT craze around the world, not only in India, it's come off. Today, everybody thinks IT is a sell. But maybe it's a great opportunity if you have a 3 to 5 year horizon because the cycle is going to turn around. If not now, today, later. In 2007, 8, 9, IT, infrastructure, and capital goods were just running up. Any stock or sector that you bought or even the fund that you bought would give you 50, 70, 100% return over a 1 or 2 year period. Today, nobody's talking about them. Maybe it's an opportunity to look at it right now. So though I don't have favorites, I purely go by need of the client, the opportunity present based on the opportunity of the sector and the recent 2-3 years performance of lack of any great enthusiasm over there, because usually that's the turning point in any sector, right? Though great returns are not an indication of future returns, but we know for sure significantly subdued returns may be a great opportunity to catch for a turnaround in that particular sector. Some of the things that we got right over the last couple of years, more from a thematic call, is that we've over the last 5 to 7 years, for few investors who wanted that extra exposure, our BFSI, banking and financial services, have done better than the market. Number two, our slight exposure to even commodities like gold, silver started in Jan 2022, and even some metal index have helped us, number one, hedge the portfolio. Number two, keep it slightly away during extreme market volatility. So gold in March 2020, when the markets were down 35-40%, gold was up 20-25%. See, the two things that gold does: one, when the markets fall, it doesn't fall. Two, when the markets, that is equities, fall, that's when gold typically does well. So 2 Marches in the last 2 years are a great example of how, if a particular theme is understood and done well, can work for you. So March 2020 and March 2022, if you bought gold before that, it prevented a loss and gave you a slightly better post market aggregate return. But if you bought in March 2020 or March 2022, in both the cases, in the next 1 year, you made a loss because you bought gold at the top of the cycle. Likewise for IT, likewise for infra. Therefore, my one simple suggestion to all of our viewers is, please do not chase return. If you like a particular theme or idea, buy it before it's popular, not after it's popular or while it's becoming popular.
Great. So Santosh, as you mentioned about returns, another thing I really thought to ask you, and this is a very common question that even investors ask, is about past performance. How important is past performance, and how important it is to review past performance when it comes to selecting thematic funds?
See, if I take Jan 2021, sorry, the whole calendar year 2021, Nifty itself gave you about 20 to 21% return. That's a broad index, right? If you take the IT index, would comfortably given you double of what the Nifty gave, 35 to 40% return. If you take some well diversified funds, they gave you almost 50-60% return in that just one calendar year period. Now what we'll do, hey, Nifty gave 20, index gave 40, but my thematic IT fund gave me 60 or 50% return. Let me put all my money over there. Now, returns are good measure to see the potential and the alpha generation that the theme can deliver. But if I were to chase this particular theme just because of the returns I saw in 2021, we all know what would have happened today as we speak on 18th of October. IT has bled, literally. You're down maybe 30-40% if you bought at the peak of 2021. Likewise, if I see a particular a theme or a sector, last 1 year, lesser return than the market. Let's say market gave me 0% return, but there's a sector that's given me -10, -15. Let's take, for example, that sector is, let's say, the banking sector. Now, in the last 1 year, Nifty is given 0, but banking is given -10. Now, we know banking and financial services are a significant part of the index, overall index. And if the index has to do well, at some level, the banking has to bounce back. At some level, not only bounce back, they have to go higher than just the market's performance. So then maybe I have a chance to say, hey, let me look at a sector that's taken a beating more than the market. And if the market were to perform, it will do well. Returns are just one lag indicator. The other indicator is maybe banking sector is not caught up to the market performance by all the sectors. And if I were to be a little more patient by 1 or 2 years, maybe I'll get rewarded for taking that extra call on the thematic space. So performance or underperformance then become lead indicators or lag indicators. Only performance become lag indicators. Performance plus the understanding of the sector will give you a combination of both forward and backward looking parameters to help you make a more informed, practical decision.
Great, Santosh. As you were mentioning about index funds, that leads me to my next question. Industry-wide, we are seeing quite a popularity for index funds. What's your view about thematic or sectoral index funds? Are these better starting points in general versus actively managed funds?
So you're asking two questions in one, so let me try and break it up. See, there are a lot of investors who feel, hey, I'm going to come into the market, but I want to pay it passively, which is I want to eat food. I don't know what to eat. So let me go to a restaurant where every food kind that I like is there. Let me just pick and choose what my mood suits. Essentially, you're avoiding making a decision. You're saying, no, I don't want to choose IT. I don't want to choose banking. I don't want to choose metals. I don't want to choose infra. I'll go, whatever is there, little bit, pinch bit, I'll take, bite size, I'll take, and I'll enjoy the whole thing. On the other end, you're saying, hey, listen, I'll come. Can you please help me how to pick? So the active fund management is you come to a particular scheme, which is number one to a company, number two to the diversified route, and number three, you're telling the portfolio manager, I understand your scheme, the size of the fund, and the style of the fund. I rather be here than pick something myself. But today, thanks to the massive growth of online investing, massive growth of new investors, massive growth of information on internet and social media about investing, the passive as a category is growing, which is the index investing. They're saying, hey, I don't know where the markets are going to go, but if the market goes up, I want to get my feet wet over there. So you buy the Nifty index or the Sensex, or it could be the banking index. Now, we spoke so much about one sector called the IT sector. Like I gave an example of 2021, Nifty gave 20, IT gave 40. You're saying, in IT, why should I select an Infosys or a TCS or a L&T or a Mindtree versus a Tata Elxsi or KPIT Cummins? I just buy the whole pack. That pack may have 30, 40 IT companies. That IT companies will then give you a breakup between mid cap, large cap, small cap. Just buy that and forget it. You have your Wipro, you have your HCL, you have your TCS, you have basically all these same companies are competing in the outside world to get contracts. You're saying, I'll buy the whole list of companies. Now, I don't know which one to buy. Now, within this, I believe that being passive will make more difference than giving it to an active fund manager, because what an active fund manager will do, if TCS has got 10% weight, he may take a 15% weight. And if HCL has got, let's say, 2% weight, he may take a 5% weight. Or likewise, if TCS is 10, he feels that some other stock will do well. Instead of 10, he may give it a 5% weight. If people see value in that active selection and they're happy with it, they'll come to a active yet sectoral or thematic fund. But what you are asking me a question is two layers of refinement. One, I know my sector. Two, within the sector, I don't even need a portfolio manager. I'll just blindly stick to what the constituents of the index are. And the index, as you know, gets regularly churned based on the top guys by average market capitalization.
Right. My next question is about psychology of investors. In fact, we have seen many investors who get carried away by the sudden high short-term returns of thematic funds, and many of them, in fact, invest with greed. What are the checkpoints that you would recommend to these investors before they, invest? Also, if you can share your words of advice for investors who are specifically looking to invest in thematic funds, Santosh.
Well, I'm hoping that a few points that I share will be helpful to people. If you see something which is too good to be true, you must ask yourself, is it really too good to be true? Is it repeatable? Where returns made out of luck or returns made because a particular sector did better than expected? Now, when COVID came, the whole IT space got a huge boom because work from home, cost savings, need for automation, need for more software, all these things kicked up. Now, you cannot expect a particular journey to be endless. At some level, it's going to pause, it's going to stop. So I think if you just follow the basic premise, if something is too good to be true, please doubt it. Right? Number one. Number two, if ever you can see a difference between a sector to a diversified fund to the index being disproportionately high, maybe it's a nice sign of caution. A classic example I told you, 2021, recent in our minds. Index 20%, IT index 35-40%, funds giving 50% return. At every level, you had a 50 to 100% alpha. Maybe it's a nice indication of froth, right? So avoid those things. Now, the third and the final thing, in spite of whether there's a froth or no froth, please do not go all in or all out. We are not buying lottery tickets. So many people consider investing like, if I don't put more money to it, it doesn't make sense. No, we are not taking a chance. We are not taking an option of making money. We are investing in fundamentally sound schemes which have an investment objective and rationale. So most performance or underperformance is all relative. It's all a point in time, correct? So therefore, if you invest and stay the course, returns are bound to come. It's not that because you took IT, you made money or lost money. Even in a diversified fund, IT would have been there, maybe slightly lesser exposure. So my advice is, if it's too good to be true, doubt it. Sense for froth. Third is, don't go all in or all out. Always makes sense to have reasonably prudent exposure so that you don't miss out neither do you become overexposed to a particular sector, no matter how good it is.
Great, Santosh. I think those were really valuable insights on thematic funds that you shared with us. And I'm sure viewers must have gained a lot of expertise from you. Thanks so much for joining us today. Before I take the questions from our audiences, and I'm really getting a lot of them, I would, highlight some of the key points that you mentioned as we were discussing. You said that it is important to evaluate, one's risk profile and goals before they start investing, whether it is thematic funds or any kind of investing. You would ideally look at some of the parameters like age of the fund, pedigree of the fund managers, and of course consistency of performance when you give suggestions or selecting thematic funds. You had also mentioned that it is important to have the risk reward ratio in your favor before you start selecting thematic funds. One should be aware of the risk reward ratio, and of course they need to understand their need for investment rather than just chasing the returns or the flavor of the month. When it comes to thematic investing, you had also highlighted 10 to 15% exposure in any of the dominant themes could be a preferable exposure in when it comes to thematic investing. And last but not the least, have an optimum exposure and not overexpose yourself when it comes to thematic investing. So these are some of the key points that I could make a note of. Santosh, if you think there's anything that I need to add, you can also add that.
I think you brilliantly summed it up, and I was listening to it, and I think if I should make notes of it and remember it myself too. But I think that is a good encapsulation of what we just discussed. I think people missed out the whole session, but even if you were to just take the few points, I think we drive home the point of what we're trying to convey the last 45 odd minutes.
Absolutely. So, Santosh, I would love to take some of the questions that our audience has shared with us. So, here comes the first question. Where will be Sensex in the middle of 2023? And how much percentage of chance of recession is there next year? May not be very relevant to thematic investing, but maybe he wants to understand about where the economy is going or the markets are moving. Your views on it?
I am sorry, this is going to be a very disappointing answer. I really do not know where we're going to be in 2023. Now, as far as recession is concerned, now it's very fair to think that the world is moving from extremely low cost of funds or low interest rates to an interest rate which is actually at almost a 5-10 year level. In fact, in America, it's at a 15-year high level, right? Just give you in perspective, about 1.5 years ago, the cost of funds in America were less than 0.5% or thereabouts, around 0.5%. Today, that cost went up all the way to 3%. Now, they're not used to these kind of high interest rates. Now, whenever the cost of funds or the tightness of the funds happen, there's a cutback in spending, and cutback in spending or lesser spending means recession. Now, you don't need to get overtly worked about these technical economic terms. Basically, when the spending ability goes down, and therefore the consumption amount falls, therefore the production amount falls. If there is a sequential drop between one quarter to another quarter growth, it's called recession. Now, usually this is confirmed when you have at least 2 to 3 quarters of sustained numbers of a negative growth, right? So therefore, we may go through recession, but we also have to remember we're living in some very interesting times. Whether it's a boom or a recession, some of these things tend to play out much, much swifter, faster than what we can anticipate. So I personally do not know how this inflation is going to be. Quite frankly, most economists in the world are divided between short, quick recession, long, sticky, and ugly recession. I, for one, don't have a view about how good or how bad this recession is going to be. One, it is fair to anticipate a recessionary situation or environment sometime in the between now and the next year or so.
Great. Santosh, my next question is on digital funds. Is it a right time to invest in digital funds? And what's your view on that?
I think we've spoken so much about the digital and the IT side today. Yeah. See, it's not about the time. It's about the opportunity. See, Just change your nazaria, as they say. Should I look at past performance or should I look at the investment opportunity? Now, many people think IT is a big beneficiary of a depreciating rupee because we bill everything in dollars, and when we get the money at a greater value for a rupee, we get more dollars or more rupees in our kitty. Now, that aside, what is the opportunity our Indian IT services as an industry have in the next 3, 5, 10 years? That should be the reason why you buy a digital fund. Because right now, the argument is, oh, since Jan to now, tech funds or digital funds or IT funds have fallen 30, 40%. Nifty is flat, funds are fallen. Maybe it's a great time to buy because it's negative. I think that alone is not the reason. If you believe, if you follow, and if you think that IT as a sector or a theme has got a sustained long-term future, then it makes sense to buy. And if it ever falls further, another great opportunity to even average out lower and to stay within the parameters or the limits that you have. See, it's always easy to think that if it falls further, I'll buy more. The question is, you also should not bust the limits of what your exposure should be. Like I said, however good or bad it is, stay within limits.
Santosh, my next question is actually on a theme which is quite interesting. In fact, this is a common question that's been asked in many of the sessions that I attend. What's your view on art as a theme? And also, if you can add, about your views about real estate or REIT as an investment idea.
So first, I'll go with REITs. Today, you have only some 3 REITs and one InvIT, I think. See, all the questions they asked are great investment teams globally. Now, in India, we are a developing nation, and our investment appetite is getting better by the day. So, an investment appetite consists of 2 things. One is the availability of the products. 2 is the interest from the investor. Now, when the products are available, interest comes in, and when more interest comes in, more products come. For example, silver as an investment was given green light approval to invest in ETFs only in Jan 2022 by the regulator SEBI. Similarly, we do not have a fund yet on the mainstream for art. REITs started 3 to 4 years ago. Now, all these are good alternative investments. Question is, you have very limited options, and the options being limited and small, today, very few people take exposure to them. But this will change. For example, 10 years ago, you had less number of thematic schemes than what you are today. 10 years ago, you had practically very limited exposure to index funds or what we call the smart beta funds than what it is today. But the industry is evolving, right? Now, if you were in the developed markets like the US, you have art funds as easily available like a mutual fund, but not so in India. We also have to understand we have completely 2 different purchasing powers. Usually, all these things come to the top or maybe more popularity depending on how economy or a nation progresses. When the whole pie increases, that's when alternatives come into make a play. So maybe we are a little early for art funds and maybe even more real estate funds to come in. But what we have are pretty good, and they're robust because the regulator is behind them, and there's a lot of work gone into allowing such products to be in the marketplace.
Great. My next question is actually on the international funds. What are the international themes that you can suggest your clients now? What are the things that investors can focus on when it comes to international funds?
See, first things first, international funds have a couple of things going for you. Number one, it gives you exposure to outside your domestic country or economy. Now, if you're someone who believes that you want to play the whole world as a stage, then you need to have international funds. Number two, by the virtue of all these assets being denominated in the dollar, you're benefited in the last 1 or 2 years because of a rupee depreciation against the dollar. So it's giving you a hedge against the currency. Number three, there are many economies and many companies that are there that we in India do not have exposure to. For example, if you take some of the top 4 or 5 companies in the world, you don't have them in India. Amazon is not in India. Facebook is not in India. Netflix is not in India. Apple is not in India. Google or Alphabet is not in India. Now, if you want to play those themes, you've got to invest internationally. Now, if you're saying, no, I am happy being in India because I believe our Infosys TCS is better than Netflix, Amazon, and Google, that's fine. Right? So I think the awareness of why we are investing in internationally is more important than just the fad to say I'm an international equity investor. Now, while investing internationally, like I told you, the benefit of exposure, the benefit of currency, and also reducing the overall standard deviation of the portfolio adds because of the negative correlation to Indian equities. It makes a case in point for investor who is at least got a little bit of understanding about his investment portfolio to consider these things. I would not say, sign off completely from international investing. If the hat fits it, wear it.
Great. So my next question is on your views on energy and hospitality funds, and if that is something that one should invest in as well.
Again, 2020 was a brilliant year, including 2021. Our hospitality was the worst affected sector. The last 3 months, all over the world, you try to get a plane ticket, try to get a hotel room, try to get a pass to any of the theme parks. It's almost impossible. What was suppressed for 1.5 years is now in super action for the last few months. It's a theme that's playing out. But to be careful, it's a cycle. If you buy all the hotel stocks, airline stocks, hospitality stocks today, because you feel the entertainment has come back, people are no more scared of the pandemic and they're going to go out. Remember, at some level, it's going to normalize. Likewise, energy, because oil has just been on the boil in the last 7-8 months, thanks to the Russia-Ukraine war, and oil price from some $50-60 went up to 120. Now it's still at close to 100 odd levels. One gets carried away because of the current present situation. I would rather say, rather than taking up what is the lead top news of the moment, please go by what is the opportunities that are there to make your portfolio more robust, risk reward oriented. As I see, the questions are coming more from almost like breaking news and hot news. So my just general rule is, please avoid anything that grabs your attention just because of what's happening in the present situation. Because remember, when you invest, you're not investing for the next 6 months or 12 months. You're probably going to invest for 2 years, 3 years, 5 years. And you like longer stories to play out than something that performs well first 3 months and then goes on a decline.
Great. Santosh, my next question is about index investing. Of course, we did mention that, but the gentleman, Mr. Vikram Prabhu, wants to know, factor-based investing or index investing over an active fund in mid-cap category specifically. Any recommendation do you have in this sector?
See, I don't recommend, but today what's happening is there are plenty of index funds available in the themes. So today, actually, if you look at it, the gentleman whoever asked this question, so we are actually spoiled for choice. Earlier, there were only diversified funds. Then we started begin to get lucky when we started getting thematic funds because we felt happy being in a thematic fund. Then you started getting index funds. Now in thematic schemes, you get index funds. And within that, you also have mid cap fund, large cap fund, and small cap fund. For example, if you don't like Nifty, today there are funds like Next Nifty 50. Now, if you don't like Nifty, but you like equal weights in the Nifty, I think your fund DSP itself has got an equal Nifty 50 fund. You see that within the index, within the theme, and within the team, you have a subs category which makes it even easy, basically spoon feeding the investor to choose what he wants. So I think if you know what you want, just go for it. You don't need to ask a question about whether I should go for it or not because it's easily available over there. And I think, to be fair, every fund house is putting out a product which an investor feels he can self-serve himself. I think the availability of the products today is saying that I cannot expect the investor to be either fully informed or not informed. There is a bunch of investors who know what they want and they specifically just want that.
Great. Santosh, I think you had brilliantly covered most of the sectors and themes that is currently in talks. And, the questions are also well answered. It was great having you in the show, and we really look forward for more conversations with you in future. For all our viewers, if you need help selecting the right thematic funds, leave a comment behind on the YouTube stream and we will contact you ASAP. Like Santosh had highlighted, and even we truly believe that if you are evaluating thematic funds for your portfolio, it is important to check your risk appetite and risk score. We highly recommend to visit our website, dspim.com, and use the personalized recommendation tool Sathi. It's a complimentary tool for anyone, whether you are an investor yet or not. And it is just going to take you 5 minutes to go through the questionnaires and know yourself and your risk appetite better. I'm going to share the link with you in YouTube description for your reference. Hope you have some time to check it out and use it. Santosh, once again, thanks for joining us in the show. Have a good evening and happy investing to all of you.
Thank you, Shimona, and thanks to everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.